Hello everyone, welcome back. I'm going to be doing another trade review today for one of the trades I took last week. Ideally, I would have liked to have uploaded this over the weekend, but I wasn't able to, so I'm going to be uploading it today as well, which is fine. I'll try and get another one out this weekend from some of my trades this week. But yeah, this is a trade I took last Thursday, I believe. This is going to be on oil, crude oil, as you can see, on the 5 minute time frame. For my time, I think my two entries were at 3:25 and 3:30 p.m. So that's just at the end of the New York kill zone. And yeah, it was a nice trade, and there's some particular things I'd like to go over. Which you'll understand more if you saw my last video explaining my last trade. So perhaps go back and watch that first, and then you might see a few repetitions of some of the concepts I'm talking about, because I have quite a particular way of viewing the market and a certain characteristic I like to look for. But anyway, let's get into it. So this is oil. It was quite a quiet day in terms of news. This is all the news we had. We had a dollar bank holiday, so typically those are quite quiet days. We had some pound news, but no big numbers release or anything like that. So a fairly quiet day in terms of news. So going into today, I wasn't really expecting much. One of those days where you just have to kind of let the market tell you what it's going to do on the day. I didn't hold too much expectation going into this day. But anyway, as we got towards the end of the New York kill zone, I was looking at oil, and I could see that this was the setup we had on the 5 minute time frame. I look at all time frames, but I tend to typically execute on the 5 minute and below, so I'm just going to start on that today. And so I had seen that we had taken this level of buy side liquidity, and we had two more fairly obvious levels of buy side. So I'm going to make this top one green because that's my overall target, and this level is sort of a level for partials, if you will. So this is what we'd taken. We'd taken buy side liquidity here, and we had a fair value gap here. Now, from watching the last video, you'll know that once we take liquidity, I like to look for us to pair that liquidity. So we've taken buy side here. So then when we take buy side, I typically like to see us come down for sell side liquidity. And then once that's happened, I then wait for the market to tell me what direction it's going to be going in next. However, this one's a little bit different. So as you can see, we took the buy side, and then we did get a fairly strong retracement lower, but we didn't actually make it down to the sell side liquidity, which was a slight problem, but it doesn't mean that I can't take a trade. So we'd had this retracement lower, but as you can see, the bodies had stayed inside the fair value gap. Then this candle told me everything I needed to know. The 3:20 p.m. candle told me everything. So this one candle, let's make it a bit bigger. So after the retracement and staying inside this level, this one candle closed above 3 premium arrays. It closed above, let's make it a bit bigger, this volume imbalance, this fair value gap, and this volume imbalance. Now for the market to do that, especially closing fully above a fair value gap, takes a lot of energy. So even though we hadn't managed to pair this and take this low, the fact that we'd held the fair value gap and had closed above all three of these PD arrays, including the fair value gap, that shows me a lot of willingness to go higher. It takes a lot of energy to do this. And to be honest, the fact that we hadn't come down for this now, after this candle, is a good thing. I would prefer to see this rather than for us to take this. Because the fact that we weren't able to get down here, but we've still had this reaction, means that they want to make it happen quite quick. They don't have time for it to come all the way down here. They'll give a slight retracement to scare people out who have bought here. But as you'll know from the last video, the reason that the narrative behind coming down for sell side after taking buy side is it kicks out the trailing stops. So it hasn't done that here, but after quite a deep retracement, you know, if you think when this candle was all the way down here, if you'd bought here, that's going to squeeze quite a few people out. So, yeah, the fact that they'd done this and then this, that tells me that they're in a rush to go higher. They want it to happen fairly quick because they didn't have time for it to come down here. So they filled the fair value gap. They then closed above these premium arrays. So once we close above those now become discount arrays. So we can look to buy those. Now where's my next target? So we've taken this level of buy side, squeezed a few people out, and we've now shown that we want to come higher. So what do? I zoom out and I find the next obvious target for buy side liquidity, which is here. Now this is fairly close to this. So I'm looking at both of these. This is my overall target, so this is where I'll put my take profit. But once we get to here, I will also take partials as well. So let's take this off for now. So the only drawings I have is this fair value gap we closed above and this volume imbalance we closed above. So as you can see, my first entry was on this candle here, and I entered as soon as we came down to touch this, because once we closed above it, this is now a discount array. Now you will see that even though I bought on this candle, the spread made me enter up here, which I wasn't happy about. I obviously wanted my entry down here, but it was up here. But the theory is correct. The theoretical idea of buying this volume imbalance still works. So I bought when we returned to that. I bought 10,500, and then I bought another 10,500 when we got down into this now balanced price range, and I was ready to take another entry if we got back down into this volume imbalance, but we never got there. So ignoring where the spread put me at, my entry was around here from an average of the both. And I put my stop below consequent encroachment of this wick. Because if we're going to come down lower than this wick, we're probably going to come down here. So this is what the trade looked like in my head, just over a 1-to-1. But because of the spread, it was more like a actual 1-to-1. Yeah, it was about there. And so had my entry been down here where it was supposed to be, when we got here I might have closed all of it, but because my entry was only just below this, I took a partial. Now, when you're in a trade like this and you have two levels that you're looking for it to shoot for, typically when you take the first level, you want to see acceleration for the next. You don't really want to see it hanging around, and you don't really want to see it dropping back down. However, this example is slightly different. Because when we came down here, we didn't kick anyone out. Once we come up here, kicking people out, so taking the trailing stops, is still an option. So the reason why I didn't move my stop to break even once we'd taken this and I'd taken partials, because that's typically what I do. Once we take partials, that's when I move my stop to break even. But because we hadn't kicked anyone out here, that's still a valid option. So just because we're coming lower, that doesn't mean we're turning around. It just means we're kicking people out. So we're taking out their trailing stops. So that's exactly what happened. We came up here, took my partial at buy side liquidity. We rushed down. What did we come for? This swing low. Didn't need any more than that. We did come down for the volume imbalance, but that's fine. That's the first untouched PD array below this low. So that's exactly what we wanted to see. Taken the buy side. Anyone that bought here and placed their stops here, they're out. and then the next candle, in one big candle, we came all the way up for here, and then yeah, we continued on after that. But I think someone gave me a comment about my poor risk management for the trade, which I'm guessing they were referencing the fact that I hadn't moved my stop to break even after taking partials, which, yeah, fair enough, isn't usually what I look to do, but there was reasoning behind that. The reason was I was still allowing for us to come down for the trailing stops because we hadn't done it here. And yeah, if it had come down to kick me out, I think it would have been around break even. I think this partial was around the same as what my stop loss was at this point. So yeah, it would have been a break even trade, which is fine. I was confident that we were coming up for here. The only other thing I wanted to show for this was my bias on dollar at the time, because that helps with knowing what direction I was looking for, because I don't just look at whatever I'm looking to trade. I typically am always looking at dollar as well to give me a general idea of direction for the market. So for those of you that don't know, oil and dollar are opposites, I suppose. So when dollar goes higher, typically oil comes lower, vice versa. So as I mentioned, this was a quiet day in terms of news, so I wasn't expecting a lot from dollar. But let me start on the daily time frame, because this is where my analysis started for this. So this trade happened on the Thursday, which is this candle here. Previous day was the Wednesday, which was this candle here. So as you can see, this Wednesday was quite a big candle. We had it was a big down day, a fairly low close, so a fairly long bearish body, but we also had quite a long wick. And this candle had accomplished a few things. We'd taken 2 levels of internal range sell side liquidity and given us a long wick. Now, anyone that's familiar with ICT's concepts will know that long wicks, especially when they've accomplished something, in this case it's taking 2 levels of internal range sell side liquidity, when you have a long wick after doing that, you can take your Fibonacci, place it on the wick, and the center line, the consequent encroachment line, typically will be quite sensitive when returned to. So we'd taken internal range sell side. I had my consequent encroachment labelled. If dollar was bullish, I would have liked to have seen it come down to touch this level, or at least get close to it, and then I would want to see some form of bullish break of structure afterwards, which I may have entered on. However, when we get down into the time frame, so this, between these 2 black lines, is the Thursday that I was trading on. This is the consequent encroachment, this purple line. So as you can see, we'd come down, we'd touched it a few times, but it had not been too sensitive. We were able to get below it a decent amount. This isn't really what you'd want to see for bullishness. If you're expecting to see dollar rally off of this level, this isn't really what you'd want to see. So we took that entry at 25 past 3 and half past 3. So on this candle and this candle is when I bought oil. Now when I was looking at dollar at that time and just before that time, I'd seen that we had got to this level, we had rallied away from it, especially with this fair value gap here. Outline this. And so yeah, so if you wanted to see bullishness, you'd probably want to see a return to this, and then you want to see bullishness away from that. However, as I mentioned with oil, we closed below the fair value gap, which takes a lot of energy. This is called a balanced price range now, and because we're below this fair value gap, this is not bullish at all. It's shown too much willingness to get below this level, and if it wanted to react off of it, this was the place to do so. But we've got below that level, so I'm now bearish, and as you can see, we get a lovely little wick up into here. Doesn't need to come up very high because this is a balanced price range, so it doesn't need to reprice any higher than just barely touching it. And then this next candle closes below that. So at that point, I'm heavily bearish. We did take this small sell side liquidity pool, but as you can see off these two candles which I entered on oil, we rebalance that and then we close again lower. So what do I do when that happens? I zoom out and I find the very next level of sell side liquidity, because as far as I'm concerned, the market has told me it wants to come lower. So first target I'm looking for is the next level of sell side liquidity, or if there was an imbalance before this that we hadn't touched, that's what I would be labeling. But the first target I can see is this sell side liquidity pool, so that's my target. And as you can see, dollar delivered lower, and lower dollar means higher oil, and that's exactly what we got. So yeah, we took it here at 345, which was when I got my partial. Then we had the retracement, which I'm guessing would have come here, and then dollar gave us another stab lower, which is what would have given us our run to profit. So there you go. That's my review and my thoughts behind the trade I took last Thursday on oil. I hope you enjoyed, and I will see you at the weekend for another review. Have a good one.